Good morning, everybody, and welcome to our May 2022 IFRS webinar. This one is always a very special one because it's an accounting standards update, getting ready for 30 June 2022. As you would have seen on the registration page, this particular webinar, we've changed to a 90-minute webinar. So, getting ready for 30 June is 90 minutes. And in November, when we say get ready for 31 December, it's 90 minutes again. All the others are still the normal 60 minutes. So just a reminder, it will be for 90 minutes. Also, in the handout section, we've uploaded the PDF of the slides, and you should have received an email with that as well around 10 o'clock this morning. Now, before I continue my ramblings, Kevin, you're looking so smart this morning. I didn't know you still own a suit and everything. Good morning.
Good morning, Aletta, and thank you for that. Yes, I thought I'd grace the presence with a jacket on today. I guess it's a formal day. We got a 90-minute presentation today, and this is always a special halfway during the year sort of presentation. So I thought I'd dress for the occasion. It's lovely to see you, and it's good to be here again.
Thank you, Kevin. It is really good to see you. So our presenters, Kevin and I, as always. So we thought we'll start with a little bit of, where can we find IFRS and corporate reporting information? I think this is the one question that a lot of people ask us on a regular basis. If we are looking for free resources, if we want to read more after the webinars, etc., where do we find it? So at BDO, we actually spend a lot of time, and we've got a team of people who put IFRS and corporate reporting information together. So on our BDO website, you can find a lot of amazing stuff. We have our monthly corporate reporting insights newsletter, and you'll see that from this month, we also have a new section on public sector issues, but we look at all the main issues. We try and cover it in corporate reporting insights. On average, we've got around 10 articles per month, really all the latest and greatest. So you can register to receive that. It's also on LinkedIn, but it's also on our website. Obviously, we have these monthly webinars that you would have watched and continue to register and watch. But on our website, if you go to this particular link to IFRS and corporate reporting, we have a section on lease accounting, because as you know, we've got a technology solution, and that part of our business is still going crazy. So information on BDO Lead. We've got information on insurance contracts, the new IFRS 17, which is new. Obviously, sustainability reporting hot, literally. So sustainability reporting, climate change, all of that in sustainability reporting. We've got a section on general purpose financial statements, and to get ready for that by 30 June this year. We've got a section where all our publications are placed. We've got a section for the training hub, where all our seminars, our e-learning, our webinars, everything is there, and a section for BDO in the boardroom. So there's a lot of information. However, some of the feedback has been, you've got all this information, how do we access it? How do we find it and not waste a lot of time? So obviously you can search and it will come up through Google and our search function. But what we've done, and it's taken a few months, is we've created topic pages for different topics and standards. So this is an extract from the leases topic page. So there's a section, all the articles we've ever written on leases is there. We've got our global resources, IFRS in practice. Everything global has issued on IFRS 16 is there. We've got webinars, every single one that Kevin and I presented on leases, we've put there. IFRIC agenda decisions, including the one on lease term, the contentious one, all of them are there. And then online training courses. So if you want to do online e-learning, if you want to watch recorded seminars, case studies, solutions, all of it is there. So for every topic, there's a little section where you can find everything BDO has on offer. We have it internally for our staff as well. This is now externally for our clients, and I think a great addition to our website. So if you look at that training page, you know, we've got the webinars, we've got seminars, we've got e-learning. The e-learning is a section where it's behind a pay gate, and this is more or less what it looks like, and it's for every topic. So if you have a particular topic that is now important for you with general purpose financials, you can go there and find out more. Sustainability and ESG, I'm super excited to announce that just yesterday we've released a new web page on our BDO Australia web site for sustainability and ESG, and we'll tell you what we do about sustainability and ESG at BDO, internally what we do, but also how we help our clients. So you could look at that. The other thing is we've started this year with a 6-month series on webinar, a webinar series on ESG and sustainability. You can watch recordings or you can still register for these ones. Last week we looked at stakeholder engagement. You know, next month we're looking at measure to manage around sustainability reporting. This has been a very popular webinar series. It is an issue that's really taken off. The other thing I should add, on our website, you would all know there's a lot of talk about a TCFD disclosures in financial statements, the Task Force for Climate-Related Matters. We've got an e-learning course, and we've made it available to all our clients for free because it's brand new and it's very important. So on our website, you can also find that. The other thing we are doing, and that's Ashley and I, we are running workshops for clients. So if you're interested in a sustainability or ESG workshop for your business, especially if you're a board member, you want the Audit and Risk Committee to look at it, or the board to look at it, finance teams to look at it, we're very happy to run these workshops for you, where we talk not just about the risks around sustainability and ESG, but also the opportunities. The other thing I should say around sustainability and ESG is in your OFR, your Operating and Financial Review, that go with your financial statements, Asic has made it very clear that they would expect to see disclosures around ESG and sustainability risks. You know, and it's a focus area. So previously, or in previous years, Asic wanted to see disclosures in the OFR around COVID, the pandemic, JobKeeper, and they've been really active in that space. This time they're saying in the OFR, at a minimum in the OFR, we want to see climate disclosures, climate risks. So in our webinars, we explain that a bit more. The other thing I want to touch on upfront is not-for-profit entities. So today we're doing a general update around accounting standards and what's new for 30 June. For our not-for-profit contacts clients, we're doing a special not-for-profit webinar on the 1st of June. It's hosted by Anthony White, our national not-for-profit leader, and I'll be presenting on accounting aspects, but we'll also have a panel discussion where we'll be joined by 2 of our audit partners, Leah Russell, an audit partner in Sydney, Elizabeth Blunt, an audit partner in Melbourne, and also Ashley Bleeker, where we're talking about sustainability, ESG, how we see it in the not-for-profit space, and also a little bit of a, you know, what's the difference between impact reporting and sustainability and ESG. So there's a link to register if you're a not-for-profit or a member of a not-for-profit board and you're interested in that. So we're not going to look at the uniquely not-for-profit issues today because we only have 90 minutes. I will touch on one thing. This is a little bit of a list of some of the things we'll be talking about in that not-for-profit webinar. There's one thing I'll put out, which is the good news, and that is if you're a not-for-profit entity in the private sector and you've had peppercorn leases and you've been worried about the AASB's position that you should fair value your right of use asset, and there was a temporary relief that you could account that for that right of use asset at cost. The AASB has finally made the decision that that ability to account for the right of use asset at cost and not fair value will be retained indefinitely. So that's fantastic news for not-for-profits. And we also include an article about that in Corporate Reporting Insights that will be issued next week, Monday or Tuesday. So after a high level of all these wonderful resources available, if we look at today's agenda, so we will be looking at the hottest of hot topics, transitioning from special purpose to general purpose financial statements by 30 June 2022. We'll touch on AASB 1060 simplified disclosures again for 30 June 2022. Then we'll look at the standards that will be mandatorily applicable for the first time for 30 June 2022 annual reports, so full years, but also some of the standards that will be applicable for the first time in half-year periods, 30 June 2022. We'll look at standards issued not yet effective, and then important, we'll look at IAS 1 or AASB 101 changes with a specific focus on proposed changes on the classification of liabilities as current or non-current. And you know, that's really important to think about that. We'll also talk about impairment considerations. We've seen a number of practical issues, having a lot of discussions with a lot of clients around impairment. We'll talk about that. We'll touch on an Asic update, what's their focus areas. We'll look at listed entities, some new rules around remuneration reports. We'll just flag that there's been a number of new IFRIC agenda decisions, none of them as controversial as the SAS customization and configuration costs we had last year this time. But anyway, we'll touch on it, and we'll touch on the Ukraine-Russia conflict. So if you are exposed because you've got investments there, you've got mines there, you've got supplies there, you've got customers there, what are some of the things to think about? So as you can see,
Aletta?
Yes, Kevin.
Sorry, I interrupted. I actually just thought I'd add to the agenda before we got going. I'm having a look at this sort of in the lead up to this webinar. I sort of two things emerging. One is the update part, and a lot of what's on here is the update. This is the value that we bring at this time of year, you know, running into the reporting. But the two areas that I almost want to say are advisory related. In other words, something for you to take out is the IAS 1 changes and impairment. So those of you who are listening and sort of planning this, I'd encourage you when we get to IAS 1 changes and the impairment sections to really listen to that in the context of do I need to react here and do something differently? Whereas the rest of it, I think, is largely take that on board as you prepare for, you know, approaching your year end. That's just the sort of way I'd approach it if you're looking at your focus areas, you know, in today's agenda.
Yeah, thank you, Kevin. So I think, as always, we try and do a comprehensive roundup of what's new and what has changed. But we also, because Kevin and I are ultimately advisory partners, we want to provide, you know, things to think about that we see when we work with clients. The other thing that I'll just flag is we had our automotive webinar, and the recording is available. This was specifically for the automotive industry, for dealers, talking about considerations when they move from special purpose to general purpose. If any of you were interested in that, it's available on our website. It was really well attended, and I think there were some good practical tips in there. So the very first section, and I'm not going to make my normal big song and dance about this one. I'm going to tone it down, Kevin, and that is the transitioning from special purpose to general purpose. I think my dance is now a little bit of old news, other than saying the time has arrived. For for-profit entities, the time has arrived. 30 June 2022 is it. And therefore, for-profit entities have to very carefully consider whether they have to prepare general purpose financial statements or not, and what that would mean, consolidated, complying with all accounting standards. Now, we've talked about this a lot. I would actually go further and say, if you are not preparing general purpose financial statements for 30 June 2022, I think you should document and clearly articulate for your auditors, for your board, why not? Because this is a big change. It's been coming for years, and we could expect some scrutiny on this, and the auditors are all over this. All auditors are all over this, Asic, etc. Now, previously, I think last month, Kevin talked through this, and I found it a fascinating presentation. Kevin, I still think it was an amazing webinar, where he talked about when we help clients on this journey from special purpose to general purpose, a project, and you have to think about your purpose, and select a fit-for-purpose transition that maximizes your business objective. And that could be you want to be asset rich, you want to be profit rich, or it's about compliance. And we also have this 5-step plan on how you manage it. So start with a position paper, identify what you've done in the past, do a health check, be very critical on the health check. And the auditors shouldn't do it. You know, it's an advisory engagement. Do a gap analysis. Think about how we transition. What's the best way transition IFRS 1, IAS 8. Think about the asset rich, profit rich, compliance rich, and then ultimately get to disclosures. So it's a reminder on that. Going hand in hand with that is AASB 1060 simplified disclosures, which we've talked a lot about as well. So I think what's important here is remember RDR is now officially gone. If you are in tier 2 for general purpose financial statements, you have to comply with AASB 1060. Most people going from special purpose to general purpose, I think, will end up in general purpose tier 2 because they wouldn't be publicly accountable, I suspect. The other thing I should say here, and this is for our not-for-profits people who are still persisting with this webinar, although they've got a special one, is that if a not-for-profit entity is preparing general purpose financials, or have been, and are in tier 2, they will also have to move from RDR to AASB 1060. So although not-for-profits are not moving on a financial reporting framework level, RDR no longer exists, so you have to move on a AASB 1060 level. Right, so that's a little bit of an introduction. I think that's old news. The next thing I want to talk about is standards that's applicable for 30 June 2022 annual periods, mandatory applicable. And we've done training on them or we included it in webinars. So it's the first one, it's around AASB 1060. It's around the removal of special purpose. We talked about COVID-19 rent concessions, and then there was an amendment that said, you know, if you are having a reduction in lease payments post 30 June 2022, you would still qualify, etc. So that's still in place. That COVID practical expedient had not been updated, so it's still 30 June 2022. You know, so there's always, so we talked about interest rate benchmark reform. If you've got any debt that's referring to LIBOR, you should consider that. Again, there was a standard on rent concessions, LIBOR, and transition relief under AASB 1 that's been added. You know, so it's new standards, no significant big new ones that's rocking the boat. It's just a reminder of ones that we've previously discussed. However, when we look at 30 June 2022 half-year periods, again, there's just one standard. It's AASB 2020-3, which is as a result of the IASB's annual improvements project. This one will now be applicable for your 30 June 2022 half years. Even if you've got a 30 June 2022 full year, this will hit you within the next 6 to 12 months. So interesting information, so you can start to think about it. So, you know, some of the changes are around IFRS 1. You know, if a subsidiary moves to IFRS after the parent have moved to IFRS, you know, how do we do that? How do we do transition? On IFRS 9, there's a small amendment around the fees that are included in the 10% test. You know, if you modify a financial liability, and I think we're going to see a lot of that post the pandemic, if you modify a financial liability or a loan arrangement, we have to assess under IFRS 9 whether it's brand new, so do we close the one and have a brand new one, or whether it's a modification of an existing one. It's got quite different accounting outcomes and impact on P&L. And part of doing that test, there's a reference to fees and how do you incorporate fees, and they've clarified that in this annual improvement. IFRS 16, they've deleted an illustrative example 13. It's around reimbursements for leasehold improvements. They thought it's a bit confusing and ambiguous, and they deleted it. And then also IAS 41, there's a removal of the requirement to exclude cash flows as a result of tax when you measure, a fair value of investment property. So these are some of the smaller changes. There's also been some update or reference to the conceptual framework and update to IFRS 3. Again, these are small amendments. The two amendments that we want to focus on today that I think are the more significant amendments is around onerous contracts, and how do you calculate and determine the provision for an onerous contract under IAS 37. There's been a bit of a change. They've added a new paragraph, 68 capital A. And the second thing is there's also been adjustment to IAS 16, property, plant and equipment, around what do you do with proceeds before you start with the intended use of that property, plant and equipment. When we talked about it internally, we thought this is something that could have a big impact in the mining and natural resources industry, that this is something that happens there a lot. So if you're in the mining, natural resources industry, maybe reach out so we can talk through that with you. So if we look at those two amendments, and I'll try and do it as fast as possible because we've got a lot of things to cover. The amendment to IAS 37 around onerous contracts. First of all, an onerous contract is a contract in which the unavoidable costs of meeting the obligations under this contract exceed the economic benefits that we expect to receive in future. So we've got a contract, we're going to receive certain income in future as a result of the contract, as a result of the pandemic, as a result of supply chain, as a result of the Great Resignation. Suddenly it's costing us a lot more to deliver on this contract. So now we've got an onerous contract, for example. So as soon as the economic benefits are less than the cost, what we would do is we would say create a provision. So it's debit profit and loss, we have an expense in the P&L, and we credit a liability provision for it for onerous contract. So that's all old news. However, they've added a paragraph 68 capital A, which says the cost of fulfilling a contract comprise costs that relate directly to the contract, which include both of the following. It includes incremental costs of fulfilling the contract. So that would be direct labor, direct materials. And I think that's always been fairly clear. But the second one, it also includes an allocation of other costs that relate directly to fulfilling the contract. So maybe it could be you use certain property, plant and equipment to deliver the contract. Therefore, a part of that depreciation of the PPE will go to this contract. So when you do this calculation to see whether your contract is onerous or not, don't limit your calculation to direct labor, direct materials. Think broader on some of those other costs that do relate to this contract and that will be allocated in future. So as we, if we look at an example, maybe we look at this direct incremental labor costs. There's an allocation of depreciation. There's an allocation of insurance, management salaries. There's incremental materials. So if you put all of that together, total incremental cost 5.1 million, your bid price only 5 million. Therefore, we estimate a loss of $100,000. So you can see if we've excluded the allocation of depreciation, if we excluded the allocation of insurance and management salaries, which I think in the past, maybe people missed that, maybe it was not clear in the standard, you wouldn't have booked a provision for an onerous contract. As soon as you put it in, you realize, hang on, I actually need a provision for an onerous contract. So I think this one is an important one to think about. If you potentially have onerous contracts and you start to do calculations to determine whether it's onerous or not, please think about this amendment. Kevin, did you have anything to add on this one?
No, look, probably more conceptually, this amendment pretty much aligns with the same sort of thinking in the inventory standard, where you capitalize direct costs to cost of production. These allocations of depreciation don't only include depreciation of PP&E, it's also things like right of use assets, and that's really important because I think everybody still thinks that the lease accounting standard is something that's going to be unwound again one day. And I see a lot of management accounts and a management accounting where the right of use assets under the lease accounting are reversed, and people go back to the old operating rental way of doing things. So they miss the fact that there's actually a depreciation charge on a right of use asset that actually belongs to this type of assessment. Is this contract onerous? I mean, the other way to think about it is the contract loss making. That is a very commercial concept. If you're entering into a contract and it's loss making, it's most likely also going to be onerous for accounting. So the accounting here very much aligns to the commercial reality of these sorts of contracts, and that includes allocations of things like right of use asset allocations where there's a direct allocation. So think about a contract that is onerous in the same commercial sense as a loss-making contract. Why did I enter into this, and what's going on here? When I talk to my advisory clients, a lot of them use different terminology, but it's actually trying to do the same thing. They'll say things like, I've entered into this contract because it's a loss leader. Well, that's another way of saying it's onerous. It might have a greater purpose somewhere else, and that might need to be factored into the economic benefit side of this assessment. But there's a commercial reason why you've entered into a loss leading contract or a loss leader, and it flows through this type of thinking. So I agree with Aletta, this is a big topic. You need to think about this and try and relate it to the economics of the assets commercially in the way you run your business, and it'll start to make sense.
Kevin, I love the angle that you bring there around the commerciality, because, you know, clients would say, do I need to do this assessment for each and every contract? And I would say no. If you clearly have a really good deal, we usually know when we've got a good deal, right? But if it's
you have a feel for it. You have a feel for it.
Yeah, so those really big successful contracts, I don't think anybody's going to expect you to do this. But all of those that are, you know, borderline loss leaders, trying to get into a new industry, new client, etc., you know, we have to look at this. The other thing to say, this amendment is an annual improvement amendment, which usually means it amends the standard, but it's it's a clarification. It's not new. So I'm thinking this is now new for 30 June half years. I wouldn't be surprised, and actually, if you think about it conceptually, this is something that we should have been doing anyway.
That's right.
For 30 June 2022 full years. It's kind of just making it really, really obvious. So I think this is something to think about even for full years, and that's why we've tried to include it. But thank you for that, Kevin. The other one is around IAS 16, and again, natural resource mining people, please listen to this one. So, you know, if you've got proceeds from selling any items that you produce while bringing an item of property, plant, and equipment to the intended location and condition, previously the old requirement, or one could say the existing requirement at 30 June 2022, that you would look at the net proceeds before the intended use. The net proceeds before the intended use would be deducted from the cost of property, plant, and equipment. So, you know, if I manage to sell things while I'm constructing and getting this PPE ready, you know, that nice money I can use to reduce the cost of the PP&E. And remember, that will also reduce your depreciation, therefore, in future. Don't forget about the depreciation. The new requirement is, if you sell some of these products while you're getting this mine or oil rig or anything ready for its intended use, you have to recognize the sale proceeds and the cost in profit and loss. The cost would still be measured in accordance with IAS 2, because you've got a sale proceed as revenue or other income, and you still have a cost on to a cost of goods sold under IS2. The other thing that they've said, and that changes it quite a bit, so we're not reducing the value of the asset, we're not reducing the future depreciation, we're booking the sale and the expense immediately. The other thing is they've also clarified the meaning of testing. So if you are assessing whether the technical and physical performance of the assets is such that it is capable of being used in the production or supply of goods or services, for rental to others, or for admin purposes. So in that testing phase, you don't know whether it will be ready or not. If you, during the testing phase, extract certain minerals, have some oil, and you manage to sell it, that will also be captured by this requirement, right? If we look at why the change, conceptually, the proceeds meet the definition of income, and the cost to extract it meets the definition of an expense, but also offsetting the proceeds against the cost of the PPE understates your revenue currently, but it also reduces depreciation in future when you actually use the PPE. So some of the effects we are seeing, major industries impact the mining and petrochemicals. We need entities to distinguish between costs associated with producing and selling items before the PPE is available for use, and that cost that's attributable to making the PPE available for use. So there's a difference. I've got cost, to get it ready, and cost to generate these proceeds. And then this could involve significant judgment and estimation. So this is something that we'll have to document, significant judgment. So another gray area. I think this will be really tricky, but an important one to think about. Kevin, did you want to add something on that one?
Yeah. Look, it's just the word offset, I think, it's probably broader than this. When we assist our CFO advisory type clients to put their charts of accounts together and journal entries going to various accounts, we generally say to them, if you've got an account that's naturally an asset or naturally an expense, but you've got credits going to that account every now and again, those credits generally are offset transactions. And the question really is, why are you offsetting? Because maybe there's a commercial transaction there that really should be represented and reported in the accounts. This amendment is just one of those. What it's trying to do is say things like, why are you taking credits to a debit account and not reporting them honestly, and the commercial reality once again? So it's just trying to bring you back to that. I almost want to say what's old is new again, because it's not a new concept, that the standard setters are clarifying, don't offset gross account and reflect the economic reality of the transaction. That's really what's happening here.
Absolutely. The next thing is just a reminder that if we've got standards that's been issued, but they're not yet effective, like the two we've just discussed, you could argue they're not effective yet because it's for years beginning after 1 January 2022. There's a requirement that we have to disclose that there are these new standards. They're not effective yet, but we also have to assess what the impact of that will be on our organization. So I've put a reminder in around the disclosures. We have a lot of resources, in particular around IFRS 17, because the big new standard is IFRS 17. That's not effective yet. And we've written a number of articles not focused on insurers, but focused on corporates and helping corporates to assess whether they might be caught by the standard in future, because there's a little bit of overlap between financial instruments and insurance, etc. And IFRS 9, IFRS 17. We also have a topic page that's just dedicated to insurance contracts, IFRS 17, if you want to find out more. And there's also a recorded webinar. The next one, which is really important, is looking at changes to IAS 1, the classification of liabilities as current or non-current. Now, what we want to talk about today, and you'll have to be patient here, there's a few changes happening. There's the current requirements in IAS 1, Then there are approved changes to IAS1. These are not effective yet, but they are available for early adoption. So I just want to put them out there. And then there are unapproved changes. And that means there's been so much pushback on these approved changes on IAS1 that the International Accounting Standards Board has delayed the approved changes, or the effective date of the approved changes, and also put out an ED to change those approved changes. So there's a little bit of risk here if you early adopt, but there might be valid reasons why you want to early adopt. So Kevin and I would say, and all of our advisory partners would say, before you go away from the current requirements in IAS1, if you want to go away from current requirements and early adopt, please speak to an IFRS advisory person, because there might be commercial reasons you want to early adopt, but let us just balance your commercial reasons with a little bit of the IFRS reality here and the risk you're taking. Because we understand commercially you do certain things, but I think you should also just weigh up the risks associated. Kevin, did you want to say something?
Yeah, I wanted to make a comment to the audience. So Aletta's highlighted the section really well, and she'll present it. But when the standard setter amends a change to a standard that hasn't even taken effect yet, that means there has been lobbying and an uproar globally on the issue. It means it has widespread implication for some very powerful companies. What that means is it's probably going to affect you too. So I would take note of this section. This is classification of liabilities into current and non-current. There can't be anything more fundamental than that in accounting standard, and everybody has that issue. So I just want to kind of reiterate Aletta's concern about the unapproved changes. What that actually means is there was lobbying that went on at the international level. Even before the changes came through, they suddenly knew changes to the changes. That is major. And Aletta is right. Before you dive into this, just please make sure you know what you're doing and what the long-term ramifications are, because the worst thing that can happen is you can have a current, non-current liability change. It affects your solvency ratios and all those sorts of things, your bank agreements, your covenants, and then all things start to unravel. So it's probably, for me, this is one of the best sessions today for you to take away before going into 30 June, is to make sure you're across these changes.
So Kevin, this is where I'm going to slow it a little bit down. I feel as if I've been on roller skates for the first part of the session, because this is so important. So current requirements in IAS1. So currently 30 June 2022, what do we have to comply with? Just recap. If you want to classify a liability as a current liability, you have to meet the requirements in IAS1 or AASB 101, paragraph 69. Now, the one we want to focus on is little d. An entity shall classify a liability as current when it does not have an unconditional right to defer settlement of the liability for at least 12 months after the reporting period. And then they say also look at paragraph 73. The second sentence we'll come back to a bit later. So let's just stick to that. Currently, if you've got a liability, it's a current liability if you do not have an unconditional right to defer settlement of that liability for at least 12 months after the reporting period or the balance sheet date. And then they say, look at paragraph 73, and paragraph 73 says, if an entity expects, now I wish I should highlight that, if an entity expects, this is about your intention. If an entity expects and has the discretion, so you've got the right, you've got the ability to refinance or roll over an obligation for at least 12 months after the reporting period under an existing loan facility, it classifies the obligation as non-current, even if it would otherwise be due within a shorter period of time. So what we're saying is, if you have the right at reporting date to refinance that loan, you already have that right, and you expect, and it's your intention to refinance, you would classify that liability as a non-current liability. Then they go further. However, when refinancing or rolling over the obligation is not at the discretion of the entity, so it's not in place yet, it's not signed, the entity does not consider the potential to refinance the obligation and classifies the obligation as current. So, you know, the fact that we're going to potentially renegotiate, the fact that at reporting date we're speaking to the bank and that we're very close to signing, don't care. It's a current liability. If you sign that refinancing after 30 June 2022, don't care, it's a current liability at 30 June 2022. If you repay that liability in August before we finalize the financial statements at 30 June 2022, current liability. So what we'll say in paragraph 74, when an entity breaches the provision of a long-term loan agreement on or before the end of the reporting period, with the effect that the liability becomes payable on demand, it classifies the liability as current. So as soon as you've breached covenants before 30 June, it's now a current liability because the bank can say we pull it back. Even if the lender agreed after the reporting period and before you've signed your financial statements that they're not going to take back the loan, they're not going to call the loan, they have to agree it before 30 June 2022. So this is what we currently have. And I think this is well understood, but let's now think about, you know, what could happen in future. By the way, at BDO Global, they can put out some amazing publications that really help Kevin and I and our clients. A while ago, they put out a publication around the current IAS1 classification with examples in there. So if in doubt, this is an amazing publication with frequently asked questions. So what are these approved changes to IAS1? So it deals with three things. It deals, first of all, that right to defer settlement need not be unconditional. There could be conditions attached to it, right? Secondly, they deal with the issue of classification based on rights to defer. So you look at the rights. Do I have the right to defer the loan? Do I have the right to refinance the loan? And you don't look at intention. Remember, currently in paragraph 73, you need the right and the intention. Going forward, it's just the right. You have the right to defer. And then the third one is liabilities that are settled by transferring own equity instruments prior to maturity. So something like a convertible note, convertible bond. There are specific rules around that, and it makes a big change, as in a massive change. And Kevin and I, we see a lot of convertible notes. This is massive. So application date, originally they said it's for periods beginning on or after 1 January 2023. It is for periods beginning on or after 1 January 2023. Initially, it was 1 January 2022. But as Kevin said, due to the uproar and consultation and new ED, they've deferred it to 1 January 2023. You can early adopt, but in our future slides, we are trying to explain why you wouldn't want to, potentially not want to early adopt unless you have good commercial reasons. And potentially the application will actually be deferred until 1 January 2024. The problem with early adopting a standard that is subject to change is you don't know how it's going to change and now you're already there. And the other thing is you can't adopt number 1 and 3 because you like them, but you're not adopting early adopting number 2, right? You have to adopt the whole thing. So just think about that. But it's good to know about these changes because if you're starting to renegotiate financing, you can keep this in mind. So we thought we'll explain it a bit more and put some examples in because that's usually which clarifies the thinking. So first of all, that right to defer settlement. The right to defer settlement need not be unconditional. The right must exist at the end of the reporting period. So there's actually a new paragraph 72, capital A. if the right to defer settlement is subject to the entity complying with specified conditions or covenants, the right to defer at the end of the reporting period only exists if the entity complies with those conditions and covenants at the end of the reporting period. So if there are any of these covenants, do they exist? Do we meet the covenants at the end of the reporting period? The entity must comply with the conditions at the end of the reporting period, even if we know the lender will test compliance at a later date. So this is problematic, in particularly if you are in seasonal type businesses, because maybe you don't meet it at reporting date, but you will meet it in 3 months' time when the lender will be assessing, as an example. Right, so it's important you have to meet it at reporting date. Example, so entity A has a 31 December year 2 year end. They've got a bank loan repayable in 5 years. The bank can demand repayment immediately if a specified debt equity ratio is not maintained at each year end at reporting date 31 December. However, this covenant is only tested on March, and the reason it's tested on March is because that's when the audited financials are actually signed. So they're still looking at the 31 December 2022 numbers, but they can actually only see those numbers in audited financials in March. So we're still on 31 December. So in our analysis, the entity must comply with that debt equity ratio at 31 December, even though it's tested after year end. And in this situation, it could be a non-current liability if we meet the covenant at 31 December year 2. So I think that one is okay. Look at this example. And this is based on the revised paragraph 73, where it's all about your rights to defer and not necessarily your intention. So for example, entity B have a facility expiring on the 31st of March year 3. Year end is 31 December year 2. Entity B has the right to roll over the loan, and they already have the right negotiated signed at 31 December year 2 for a further 12 months. So instead of expiring on 31 March year 3, it will expire 31 March year 4. That rollover is approved before 31 December year 2. At 31 December year 2, entity B actually intends to repay the loan by 31 March. So they kind of negotiated this rollover refinance just as an in-case scenario. They wanted to lock it in for in-case, but intention, they're going to repay it in 3 months' time. The 31 December financials will be authorized for issue only at the end of April. Now, if you look at the analysis here, the existing IAS 1 paragraph 73 would say that this is a current liability because we do not expect to roll over the loan. We've got the right, but it's not our intention, so current liability. Going forward, due to these amendments, if you look at this loan, it will be a non-current liability at 31 December year 2 because I've got the right locked in to roll it over, and I'm not looking at my intention. I'm just looking at the rights. So it doesn't matter that, you know, by the time we sign the financials in April year 3, we might have already repaid the loan. But still, at 31 December year 2, it will be a non-current liability. So this is quite significant. This could put quite a bit of current liabilities to non-current liabilities. And therefore, that's why Kevin and I are saying you might think commercially this is a good thing. But remember, you will be early adopting, and there are other bad things in the same standard. Another thing to think about is the third one. If you've got a liability settled by transferring your own equity instruments, so this is the new paragraph 76 capital A and 76 capital B. Currently, that second part of paragraph 69D talks about a liability arising from a bond that can be settled prior to maturity by issuing the entity's own equity instruments is classified as current or non-current according to the terms of the bond. So you look at the terms of the convertible note, for example. You ignore the possibility that it could be settled earlier via the issue of equity instruments. The fact that it's convertible earlier, you just ignore. You say the bond is for 5 years, it has to be repaid after 5 years, non-current liability potentially. What they're saying now under the new paragraph 76 capital A and B, if the conversion feature is classified as a liability or a derivative liability, the entity must consider that early conversion option, and that would impact the classification of the host debt as well as the conversion feature. All right, so this could have a big impact. I'll try and illustrate it in 2 short examples. In example 3, we issue a $1 million convertible note payable with an American-style conversion option, so it can be exercised at any time over the life of the note. Once exercised, the note will convert to 1 million ordinary shares of the entity. If the note is not converted, it is repayable plus interest on it in 5 years' time. The note is in Australian dollar and the functional currency of the entity is also Aussie dollar. Now, if you do an analysis and you use our fancy convertible note publication, again, brilliant publication, I must compliment the global guys. If you do that analysis, you would say the debt portion of this note would be a financial liability. And the conversion feature, because it meets the fixed for fixed criteria, $1 million give you 1 million shares fixed for fixed. There's no variability, nothing to do with the currency. That conversion feature is equity. Therefore, we've got a compound financial instrument here. And therefore, when you look at the debt portion and you have to decide whether that debt portion is current or non-current, you will look at the term of the note and you'll say it's a 5-year note, it's non-current. Okay, so that's not a big deal. This is the problem. Let's say we issue a $1 million note, American style conversion option, all the stuff the same, but in red, the note is quoted in Aussie dollar and the functional currency of entity C is not Aussie dollar, it's US dollar. In this scenario, if you apply our big picture and our publication, the debt portion is a financial liability, and we'll come back to whether it's current or non-current, but the debt portion is a financial liability, and the conversion feature doesn't meet the fixed for fixed criteria because we've got variability between the note quoted in Aussie dollar and the functional currency being US dollar. So there's variability, don't meet fixed for fixed, and therefore the conversion feature is now a derivative financial liability. Now, this conversion feature can kick in at any time, from day one, any time over the 5 years. And therefore, because it can happen at any stage, the conversion feature is a current liability. But here's the kicker. Therefore, the debt portion, the host debt, is also a current liability. The whole thing is a current liability because the whole thing could be exercised very quickly, any day. Now, this is different to the previous example, and the difference is, in the previous example, the conversion feature was equity, and therefore the debt portion, we look at the term of the note, and it's non-current. So it's a very slight change here that has a big impact, a slight change in the note that has a big impact on whether it's current or non-current. This is huge. We are seeing convertible notes, it's coming out our ears, it's everywhere. This is huge. What I want to add...
Can I, before you jump in there, I just want to kind of clarify that everything Aletta has said at this point is obviously skimping between the current standard, which you don't have to adopt early, and then obviously the changes that are coming, which is what Aletta's been dealing with. I just want to reiterate before she gets to the unapproved changes, if you're entering into new arrangements, especially convertible notes, and that take note of what's happening here, because even if it's not applicable this year, if the convertible notes are still effective 2 years down the line, and these things start to change, and they're going to have these sorts of impacts. So it's not just a set and forget change we're talking about now. You really should think about this, especially if you're about to sign new agreements or you haven't entered into new arrangements. But the other thing I wanted to throw out there is what's actually happening here, especially on the convertible notes, is the standard setters are catching up with the reality that convertible notes are by themselves instruments that must be settled, and settlement isn't only in cash. Settlement in shares, like a convertible note, is a form of settlement of a liability. So in a way, they're trying to also close the loopholes that existed on current, non-current liabilities and make rules that address the settlement of liabilities with shares. And then the worst scenario you can have is that you've got a current liability from a share type transaction like a convertible note, which suddenly breaches your covenants, and the covenants makes everything else a liability, and you almost have this waterfall effect, and suddenly you've just got current liabilities everywhere. So really, the reiteration of here is don't just ignore this because it's not yet effective. Think about these just holistically and what the impact is down the track. And with that, here comes the worst part, the unapproved changes.
Yes, so the unapproved changes, so there's been pushback to that, that we've just discussed, and therefore there were some additional changes. It's a fact pattern that was put to the IFRIC, and there was a tentative agenda decision. And in the fact pattern, Entity D had a 31 December year 1 year end, and the loan is repayable by 31 December year 6. Now, the loan is subject to covenants, and you must maintain a working capital ratio as follows. If it has to be at least 1 at 31 December year 1, and at least 1.1 at 30 December year 2, at 31 December, your working capital ratio is 1.05. So if, and management expects to comply with that 1.1 ratio by 30 June year 2. Right, so we're standing on 31 December year 1. We've got this loan repayable in 5 years' time. We've got an interesting covenant that at 31 December it's lower than the requirement that it should be at 30 June year 2. What do we do now? We think we can get there. How do we classify this liability at 31 December year 1? And what the tentative agenda decision was in April, and was never finalized, it then went to the main board, is it stated that the entity's right to defer settlement for at least 12 months is subject to the entity complying with 2 specified conditions. So working capital ratio of 1 at 31 December and 1.1 at 30 June. And then it said, therefore, applying paragraph 72A, capital A, entity does not have the right at the end of the reporting period, 31 December year 1, to defer settlement for at least 12 months. And therefore, this liability should be classified as current. So even though there's that requirement to meet a covenant and 30 June year 2 in 6 months' time, because that requirement is within the next 12 months, you actually already have to meet it at 31 December year 1. So it brings it back to reporting date. That's not what's written in the agreement. They're only going to test it in 30 June year 2. You think you're going to meet at 30 June year 2, but this is not unconditional, right? It's so this is a problem. So this is what the IFRIC decided. That was their tentative decision. They didn't finalize it. They went to the International Accounting Standards Board and they said, you have to look at this. So therefore, they are proposing a change, and they're saying, we are thinking to defer the effective date to 1 January 2024, give us time to deal with this. And what we're thinking to do is, if the right to defer settlement for at least 12 months after reporting date is subject to an entity complying with conditions after the reporting period. Those conditions after the reporting period, those conditions at 30 June that we had in our example, would not affect whether the right to defer settlement exists at the reporting period. So that is, we ignore the covenants where the test date is after reporting date, as we had in our previous example. So this is the proposal. So if you are early adopting this standard, remember this IFRS tentative decision is out there. This is the current reading of the standard that is available for early adoption. We don't know whether these proposals to fix it will go through or not. So be careful before you early adopt a standard that's already been approved. All right. So should you adopt, I think, you know, I understand that for commercial reasons you want to adopt. I think our thing is just, could you please consult, consider the potential implications for future. And I've included some links to articles we've written recently on this to explain what the potential changes would be and their potential outcome. So I think it would be good to consult that. Kevin, at this stage, I'm going to hand over to you to talk about the other very practical issue that's keeping us awake at night, and that is impairment consideration. So I'll mute myself and I'll hand it over to you.
Thanks, Aletta, and you've done a great job. You've done most of the heavy lifting for the last hour. So have a drink of water and take a breather. On impairment considerations, just a reminder that today is a 90-minute session. So we've just gone, 60 minutes has gone by, so we've got another 30 minutes to go. So hopefully you'll all be able to hang around and keep up. The impairment considerations isn't technically a new change. There's nothing really in the impairment standards that's changed. However, the world around the commercial aspects of business and impairment keep changing. And so in this section, what I'm going to do is just highlight a couple of anomalies that keep popping up, which may be relevant to you as you prepare for your impairment at the year end. So these impairment considerations, like I said, no new rule changes, just application of the rules that seems to be proving challenging. Now this one I actually put in at the end of yesterday as a last minute thought, because yesterday I think I had the third question on this, and I thought, well, if I've had 3 questions on this in the last month, this is clearly something that might be relevant to everybody on this call, and that is changes to the way we test goodwill and where we allocate that goodwill to the cash generator units for testing. Now, as I said, this is not a new section, it's just application of the rules. But what we are seeing out in reality is we are seeing a lot of reorganizations happening. Entities are selling businesses or assets and sort of discontinuing certain product lines. And all of that actually has an impact at the end of the day on how you do your impairment tests if you have goodwill in the business or somewhere in the testing. So this particular section I'm going to deal with is how do we test goodwill at a CGU level or at a high level when things are happening below it, and normally that's reorganizations, disposal of operations, or really just a reorganization of how the business is managed and reporting internally is undertaken. So let's jump into it. The best way to do this is actually do an example. So as I said, internal or external reorganizations and how goodwill gets reallocated. The part that I wanted to highlight today is that the operating segment requirements apply to the allocation of goodwill to all organizations, and this seems to have been forgotten. I don't know, we all seem to have a mental breakdown over this, and it sort of seems to have dropped out. Most organizations will tell you that the operating segment disclosures really only apply to listed companies, and that is true in respect of disclosures. Only listed companies have to disclose information regarding their operating segments. But what everybody forgets is that the concept of operating segments still applies to every organization in the background, and it specifically has an impact when you have different layers of business and operations. We call those CGUs, you might call them operations, but essentially different tiers of operations. operating segments is essentially still applicable to you even if you're unlisted and even if you're not reporting that information in your financials, and it has an impact in the way you allocate goodwill or where you allocate it. Basically, the rule is this simple. Operating segments is the highest level at which you can test your goodwill. And that's the concept I'm going to jump into today. Now, I played around with this last night, and I eventually decided, you know what, let's just do an example. The best way to do this is to show you in an example, on how this is going to go. Before we jump into the actual technical sides of the example, just remember what a CGU is. A CGU, by definition, is the smallest group of assets that generate cash inflows where performance can be monitored normally by management in the organization. And it's where performance is largely independent of other CGUs. Now let's put that into English. What that basically means is a group of assets that's generating revenue where information is available internally, normally on its performance. That is what a CGU is. And you can see already that CGUs are by definition groups of assets making revenue. Smallest groups that you have lower down. Now, normally when we get to this sort of discussion with clients are very quick to say, I can't allocate my costs there, or I do shared costs across business units, and I'm like, that none of that is relevant to a CGU. A CGU by definition is the lowest level where a group of assets makes revenue, and that's the determination of CGUs. It's often at a product level, it can be at a store level, anything that really is by definition a group of assets that is generating revenue. The reason why this is becoming a problem is because of the leasing standard. And Aletta will smile when I say that, because Aletta loves the leasing standard, and I love the impairment standard. I'll say Aletta makes problems with the leasing standard, and I've got to solve them with the impairment standard. So it's a great like relationship we have. So the right of use assets are proving problematic throughout the standards, but that's a good thing for us at least. And I'll give you an example. We'll take a retail scenario. Lots of organizations in the retail section have leases over stores. Those stores are generally CGUs, as you can see on this thing, because it's the smallest group of assets that generate revenue, which they've got information that management can look at. That would be a CGU. And very often what happens is we have a right of use asset attached to that CGU because the stores need leases, and the leasing stand is happening there. What's happening now in reality is that a lot of organizations are renegotiating their leases, and the reason why they're renegotiating is the way they use the lease is changing. It's not quite serving their purpose. They want to get less rent, they want to move stores, sometimes they want to lease a floor out when they don't use it because it's surplus to requirement. All of those things are indicators of impairment. So in preparing for your end of year accounting, impairment indicators are happening at the lower level assets like right of use assets, and that generally impacts first the testing of the asset and then its CGU. Haven't even gotten to goodwill yet. At the moment, I'm still dealing with the assets at the lower level. Now, in this particular example, this is actually part of a broader example we sometimes use for training internally, and I may have actually used it before in an impairment session where we've got it. But I've taken this example of being a retail organization that's got, what's that, 1, 2, 3, 4, 5, 6 CGUs. That are across the organization, 5 of them in the regions and 1 in Sydney. Now, what's complicated about this scenario is that each of these will probably have a right of use asset attached. The CGU in Sydney would probably have 5 right of use attached to it because there's 5 stores that probably all have leases. These are CGUs because they are grouped together independently, generating cash inflows, revenue, monitored by management, and they're groups of assets, so you can see that. The trick here is actually whether the Sydney CGU itself has more CGUs below it, and it probably does, because the Sydney stores, even though it might be seen by management as one group of assets, because let's say it's Sydney, it by itself has independent cash flows probably at a store level lower than that. So even those could be CGUs. All of these could be CGUs. But the trick here is the level at which management can monitor performance. And maybe in this example, I've grouped all the Sydney ones together. Where the goodwill testing comes in is actually normally above this. It's quite rare outside of the listed companies for organizations to test goodwill at the CGU level, even though you can, allocating goodwill to the CGU levels. What often happens is organizations, especially the unlisted ones, will often argue that goodwill is tested at the entity level. Now, I've called that the Australian segment level, but most large proprietary companies who are on this call, on this webinar, who have goodwill, most of you will either test goodwill at the business level or argue that that's the level to test your goodwill. Now, that is often possible because often the segment and the business level are all the same thing. But the first thing to take away from today's session is that a segment or a business level for goodwill and a CGU are not the same thing. Most of the times I walk into a conversation with clients and they say, I test goodwill at the business level because I've got one CGU. And the answer to them is probably you don't have one CGU. You're probably just testing it at the segment level, but below that, you've got all these other CGUs happening. That's the first thing to take out of this, is a CGU and a segment are two different things. Now let's move forward and actually just play around with this a little bit more so I can get to my point today. This scenario is the scenario that I'm seeing a lot of, 3 of these in the last month or so, where what's happening is there's new reorganizations happening where the CEO is maybe appointing some new national managements, and you've sort of got tiers of reporting happening and tiers of accountability and responsibility emerging. And I think it's just a sign of the time. We've come out of COVID, we're reorganizing, some people are being let go, more specialist people are being hired to look after certain product lines. So this is actually quite common at the moment, even outside of the listed scenarios. So this scenario, I've got a board that looks at the consolidated financial information, and the board is made up of a majority of non-executive directors. The reason why I've given that part of information is I don't want these guys to be the executive decision makers in my example. The executive decision makers are relevant to our segment determination, and I'll show you now how we get there. So in my example, the CEO has appointed, sorry, go back later. The CEO has appointed 2 national managers, and that report to him, and I've made this up, apparel and accessories. So the apparel manager, I'm going to say, is looking after clothing, and the accessories manager is looking after the accessories. Now, this is a reorganization, and when this sort of thing starts to happen and you've got goodwill, you need to start thinking about whether your segments are correct, and this applies even if you're unlisted and you're not reporting segment information. So in this case, the information, the CEO is getting revenue and profit by product and by store, and the managers, being the apparel manager and the accessory manager, they have delegated responsibility for staffing decisions and purchasing decisions. This is happening a lot. Things are actually changing out there. The way businesses are being run is being changed. The CEO is the one who makes decisions about opening and closing stores based on information that flows up. The board will rubber stamp those decisions. Now, this sort of information is relevant to the determination of segments, operating segments. And once again, I'd just like to reiterate, even if you're not listed and you're not reporting operating segment information, this type of information is essentially determining about what your segments are, your operating segments are, and then how do you do testing for goodwill. Aletta, jumping through to the next slide now, we go back to CGUs. We'll play around with this one again. CGUs, as I said, are the lowest level where revenue information is available and where performance can be managed. One of the key indicators of what a CGU is how management makes decisions about operations, and especially about continuing or discontinuing assets and operations. And this is becoming really relevant because lots of organizations are restructuring, reorganizing, and they're selling off maybe old operations, selling off maybe closing department stores, closing parts of the business. When management is making decisions about continuing or discontinuing assets and operations, the level at which that decision is made is often the level of the CGU. So if I think I jump to the next slide, Aletta, and I say to you that in my example, I'll go back to this. Let's assume in my case, the CEO decides to close 2 of the Sydney stores in the Sydney CGU. that is an indicator that the Sydney CGU isn't that level. It's probably lower, which means each of the stores in Sydney is also a CGU, because if you're making a decision at the store level to continue or opening or closing stores, that's probably your level of CGU. Now, that isn't actually the purpose of this section today. It's just the realization that CGUs and the way you decide to open and close operations in the business is actually a good indicator of where your CGUs are. But the purpose of today is actually talk about what level you test the goodwill. So if we jump a little bit further, I'm coming back to my little segment thing. What is the definition of an operating segment? This is relevant whether you are listed or not, and whether you actually prepare segment information. A segment is very different to a CGU. It's a component of the entity that engages in business from which you earn revenue and incur expenses, and whose operating results are regularly reviewed by the chief operating decision maker to make decisions about resources to be allocated to the segment and its performance, and from which discrete financial information is available. Now, the purpose of the session today is to show you that, first of all, there is an interaction between what a CGU and a segment is. If you read that definition, you'll see a lot of commonality in the definition of an operating segment to what a CGU is. We talk about revenue and we talk about information available about performance. But the key difference between segment and CGU is a CGU is almost a statement of fact. It's the level at which you earn revenue from various operations, the smallest level at which you earn revenue. Whereas a segment is the one where the chief operating decision maker is getting information about performance and he's making decisions about allocating resources. Now, in my example, you can see obviously that if the executive level person who's making the decision is the CEO, he's probably the chief operating decision maker in my example. He's the CEO, and he's making decisions about restructuring the business and hiring 2 managers below him who are actually one apparel, one accessories. You can see already where I'm heading to this. He's probably monitoring performance at the apparel and the accessories level, and that's probably our segments. And you can see how quickly the example has changed, because suddenly, just by reorganizing and hiring 2 managers, I may have inadvertently created 2 segments in my business, being apparel and accessory. Now, that's just one alternative. There might be, depending on facts, the answer might be slightly different, but I'm trying to lead you down the path to actually see the difference between segments and CGUs. And the fact that you're reorganizing the business, the chief operating decision maker, the one who's making some of these decisions, he's probably created 2 segments in the business, apparel and accessories. That hasn't changed his CGUs. His CGUs are still lower than that, but what's happening is 2 segments have emerged at the top. That is quite common at the moment. Like I said, 3 examples in the last month, and they all seem to be following the same sort of reorganization of the business, and they're hiring different managers. So to me, it's an indicator that this is a hot topic, and it's something you want to think about going into your busy season. If we go back to the next slide, Aletta, what you'll see now is that I've put a little slide here, and I've actually got 2 segments on the side, and I've broken up my CGUs a little bit more down at the bottom. But what happens in this scenario is we have a retail company that suddenly has 2 segments, and if they have goodwill in the business that they previously were testing as at the top, at the business level, right at the top, the standard says very clearly you cannot test goodwill at a level higher than the segment, the operating segments. And because I've got accessories and apparel segments, I've now got 2 segments, which means that before I jump into my goodwill testing for impairment this year, I actually have to take the goodwill and allocate it between those 2 segments. You haven't bought any new businesses, it's just a reorganization, but what's happened is I suddenly have 2 impairment tests for goodwill because I have to allocate the goodwill between those 2 operating segments, where previously I was just testing it at the business level at the top. Now, that's quite a big shift, and you don't want to get caught out of this in July, August, or September, just before your auditors come. Think about that now before getting into your year end and how you're going to reorganize it. The last slide on this, Aletta, I think I've actually is just to tell you that you would need to reallocate your goodwill to those operating segments for testing. There's a way to do it. You have to reallocate it on what's called a relative standalone method. And the generally accepted approach on that is to actually fair value each of the segments, or at least work out their recoverable amount. So there's sort of a valuation that actually needs to be done to work out the value of the two operating segments, the recoverable amount, whether that be fair value or value in use, and then based on those two numbers, you reallocate your goodwill. It's not an arbitrary reallocation. You actually have to do a formal calculation based on value to reallocate the goodwill, and then you jump into separate testings, impairment testings on that. Generally, the way we do it is you test your goodwill the old way before you do the reallocation, write off any goodwill, and then you actually reallocate the goodwill on the way into the new operating segment. So there's quite a bit of work here if you have this, and all that's changed is you've reorganized. You haven't bought any new businesses, and there's no new goodwill. It's just reorganization. Please take that on board. Like I said, it's nothing new. It's just I suddenly noticed it happening suddenly quite quickly across some of the clients I'm dealing with, and I thought that actually was an indicator that probably more of you out there have this to think about. On something that the Asic has, this is about market capitalization of a single CGU. Now, when it comes to impairment testing, impairment testing generally starts with indicators of impairment first. So you have a look whether you've actually got any assets that appear to be impaired before you rush off and do the testing. That's the general approach, although certain assets like Goodwill have to be tested annually anyhow. One of the things about impairment testing is whether your market capitalization, if you listed, perhaps is an indicator that it's less than the net assets of your business, and that'll be an indicator that you perhaps have an indicator of impairment. Now, the question is whether that's actually, you can use that just straight off for your impairment test, and the answer is generally no. I don't know how many times I actually run into meetings with clients where, because the indicator's there, they actually want to use that market cap as the actual what's the value worth, and then everything else just gets written off. Asic actually looked at this. Asic have raised this. Asic is well onto this. I think Aletta, that'll come up later on towards the end of the presentation. But basically, market capitalization is just one data point when determining recoverable amount, and often it's just the indicator of impairment before you even get to the testing. It's generally not used for the testing actually, although it's clearly a data point, and if you are using it in some form for the actual test, it would need to be cross-referenced or cross-checked using some other method like value in use. I think I'll leave it at that. I mean, there's a lot more on there, but I think that's relevant. And then impairment testing of right-of-use assets is an absolute minefield, and modifications of leases. Sorry, letting you jump to the next slide on this one. I feel like I actually am not going to cover this in detail. I think there's a little bit more that I'd like Aletta to cover, but essentially the unit of account for impairment testing, this becomes relevant where, let's say you've got 5 floors that you've rented, and the question is, at what level is the impairment testing done? Do you have one lease of 5 floors, or do you have 5 leases of individual floors? And what's happening out there is you might want to sublease one of those floors because you no longer need it, surplus to requirement. The question really is, what's the level of the indicator assessment where you might have impairment, and how do you run the testing on that? I want to say it's a bit of a minefield and probably outside the scope of today. There's a lot more going on here, but it's the sort of things we're running into because as organizations are changing their intended use of assets that they are leasing, and there's a right of use asset, the question really is how do you actually break that down into units for indicator assessment testing and also impairment testing? So I'll leave that one out there for something to go through by yourself. I mean, later maybe we can just jump past that one. We've got about 7 minutes left, and I'd like you to get to the Asic stuff for the rest of today. I think you're on mute, Aletta. I can't hear you. Can't hear Aletta still. Might want to jump forward, Aletta, and Aletta, I can't hear you on that one, and maybe I'll just take this one to the end. So we'll do a quick ASIC update. Aletta, did I have a slide there for the impairment indicators and resources we have? I mean, on the ASIC update, there's a lot going on in terms of ASIC materials. Now, the topics we have in this section, and I will skim over some of them, and the rest you could take for a reference yourself. ASIC has issued more guidance regarding audit committees and support for audit quality. There's an information sheet that's come out. I want to say the extension of reporting deadlines. The letter's got 2 question marks there because this is a forever changing issue that you know, coming out of ASIC and a flow on from COVID. Kind of feel like maybe we're past that now, but it is an ongoing thing. Talking about virtual AGMs, the ASIC focus areas. The ASIC focus areas are the areas that they look at when they look at their monitoring. So, are you getting your accounting and corporate reporting right? There's an area that they'll focus on going forward, but they've also got results that they've published about the areas in the past that they've looked at and the findings. And then there's ongoing issues regarding surveillance, SaaS costing, and bed license. Now, both the SaaS costs and the bed licenses we have dealt with in previous webinars, and there's an extensive amount of information on our website and articles in our accounting news. Jumping into this one, we've got features of an audit committee where there would be Ifrs expertise that you might want to consider, and this is the information that ASIC has have released. They're trying to actually encourage the right expertise and the right people on audit committees to make sure that you've got the necessary IFRS and corporate reporting skills. Now, we've put a block against 3 of those. These are characteristics of the sorts of knowledge and expertise you should have on audit committees. At least 1 member with a good financial reporting knowledge and understanding of the industry and in audit. And bearing in mind that audit committees are generally responsible for managing the audit and the audit relationship. So if you actually don't have an idea of how audit and assurance works in that industry, you can't manage that relationship and get a good quality output. These features build on ASIC and generally good corporate governance principles that basically say that everyone in the chain is responsible for good quality financial reporting. It is not just the responsibility of auditors or financial directors or CFOs or so forth. Everyone in the chain, there's a value chain in terms of good quality corporate reporting being at the center of the financial system. And so ASIC is moving this along and trying to actually push these sorts of things out through, these are the sorts of things you should be looking for in terms of your audit committee. The other thing there, the third one, which I didn't mention just as we change slides, is to make sure you actually have regular training in these directions. And Aletta will tell you that in the not-for-profit sector in particular, I know they're very good at making sure they actually bring in the right training in terms of corporate reporting and audit. Extensions of release. ASIC has extended the deadlines for 31/21 reporting dates, unlisted entities only. I think Aletta is saying there were question marks around this. Watch out for updates on this as the busy season continues. We don't expect there will be any extensions on 2022, but who knows? I also think that the election coming up will probably have some role on that, so just keep an eye out for that. Virtual AGMs, there was a temporary exemption about allowing AGMs, and those relief is the relief that was available for that is actually on the screen now. We've got your listed and unlisted registered schemes and unlisted companies. The relief to hold your virtual AGMs is as it currently is on the screen right now. You can take that one on board. I don't think there's anything new there, but I would actually follow our corporate reporting insights link, which is at the bottom of the screen. Jumping to the next slide, and we may have lost a letter for the rest of this one. We're having a bit of a technical difficulty there. What I might do is actually can't change the slides on my own. Aletta has control on that. But what I might actually do just to complete this is look down at my notes here, which I have on the printed section, just actually cover off the last sections of the day of the session. Aletta, are you back? Still can't hear you, Aletta. All right, we'll jump through to the focus areas. Good, we've got the slides back. The focus areas are the areas that Asic have been looking on when it comes to sort of their surveillance, and the areas that they think they actually need some extra attention. Impairment, my favorite one, is always on the top of the list. And it's not just impairment of your non-financial assets. We're talking about expected credit losses on receivables, recoverabilities, and so forth of deferred tax assets. So whether you've got tax losses that can be recognized as assets, those are all the focus areas in position number one. I think it's fair to say that the asset values has been a focus areas of ASIC for some time. There's nothing new here. They just keep adding rather than taking away to this one. And I think the concept is clear. Overstatement of your net asset value is obviously of prime importance to ASIC when they have a look at this. Solvency and going concern was a big issue during the COVID period. Provisions and onerous contracts have made an appearance on the list, and that we can link back to the section that Aletta did earlier on onerous contracts. But I would like to actually encourage on the listed entities, the operating and financial review in particular. This is an area that ASIC has been focusing attention on, especially around the disclosures regarding COVID and COVID support, land tax relief, and so forth. But it's broader than that. The financial report and the operating and financial review is a seeding ground for ASIC to align the narrative from management and board with actually what's in the financials. It's an area that you can actually say, well, actually, what does management say in their language and the tone of which they're setting for the financials, and how does it actually line up with what's actually disclosed in the financials? And I'd say encourage both boards and management to make sure that the operating and financial review, there's good alignment there. Now, the cloud computing arrangements, this we've covered extensively in the past on some of these webinars. So I won't go into this in too much detail, but this essentially relates to costs that have been capitalized under cloud computing arrangements. Often those are capitalized as development costs, and it's became clear to everybody, if this is internationally as well as at the ASIC level, that a lot of those costs should not have been capitalized to begin with. So they should have been expensed and should have actually been taken through profit and loss and into equity. The cloud computing thing should have been resolved by now. I think by now this is the last dregs of it. I would have expected you to have solved that by the end of last financial year, but it did roll into the first half of this current reporting period, and by now should be taken and addressed. Bid licenses, I'm going to skip forward on that one. I would say that the not-for-profit sector on our webinar that's coming up, it'll probably be covered by that, and Aletta will be on that with Anthony White, our leader of not-for-profit, which is coming up. ASIC's surveillance results, you can have a look at this yourself. These are the issues that ASIC have actually looked at on specific companies, and these are the findings or the inquiries they've had. Some of these resulted in restatements of companies, but generally these are the topics where ASIC's interest was piqued, and they went looking for more information from the company or from the auditors or both to actually try and decide whether there was something wrong in the application of accounting standards. And as you can see, asset values and impairment is right on the top of the list, and operating financial review is number 3. So those two I've already pointed out, and you can take that on board. All right, listed entity information, and I'll wrap this up really quickly. Remunerations, we've got some new requirements here about options granted to directors and other persons in a position of significant influence. So this is a new requirement or something to focus on. The securities granted to directors in their position. It's a change that needs to be picked up in your remuneration reports. And this is something that ASIC picked up, which really just rolled forward. Okay, now Aletta, we've hit 12:34. Are you still muted? She is. So recent Ifrs decisions. Aletta, you can jump over that. I don't want to hold everybody on too long. The IFRIC decisions are decisions that actually flow through that need to be taken into account as if they are standards. I mean, the short answer is you need to treat this as an accounting standard, which has essentially is an authoritative standard that needs to be taken in. Generally, accounting standards that come out of IFRS basically means if you have that particular fact pattern and it applies to you, you must apply the decision of the IFRIC into your accounting. Now, the final agenda decisions here, there were some decisions that specifically dealt with wind farms, demand deposits and contractual restrictions, and principal versus agent. These are applicable in the current reporting period, and that last one in particular hits software resellers under Ifrs 15, so the revenue recognition contracts. So those are final agenda decisions and apply. So if you've got any of these sort of topics that may apply to you, leasing for wind farms, demand deposits and contractual restrictions would be cash flow statements, and software resellers for principal and agents, they must be taken into account in your accounting at 30 June 2022. There are some tentative decisions on the go, and I'll leave those to you. The Russia and Ukraine conflict, I'd say this is probably something that Aletta is probably more attuned to discussing. She's been involved in some of the national areas, but essentially what's happening here is this is considerations for 30 June as a result of the Russia-Ukraine conflict. It is true to say that there's probably going to have more of an impact on our European counterparties, so entities in Europe that are managing the fallout from the Russia-Ukraine conflict. It's essentially a laundry list of the accounting standards and topics where there's expected to be an impact. So you can see there, Aletta's got a whole bunch of topics on the go. You can think about gas and power and energy coming through from Russia into Europe. Some of those companies are being really impacted. It'll flow through to things like impairment, recoverability, profitability by itself, so going concern. All those topics are issues that are most likely to be impacted by the Russia-Ukraine conflict. It is important that you take aware of this. We're a little bit far away here in Australia, but there may be some flow and effect, especially in supply chains. And we do have an Insight article on this, what it means for you and financial statements, and the operating and financial review in particular. All right, so I'm going to close this off as always. If you need assistance, thank you, Aletta. Not a bad go considering I hadn't seen some of those slides up until now, so we'll go with that and say it was a good test. Do you need assistance? Obviously reach out to myself or Aletta or any of our leaders across the country. You can see there we're all on board, and pointing out Etienne Gross, who joined in the Melbourne office recently. Aletta did introduce him last month, but you can see he's added there. And I think our last slide is our broader team, which is growing on a continuous basis. I think Aletta's welcoming 3 or 4 new people this week alone. So there's a lot going on in the team, and we'll be happy to help you whenever. With that, I'll close out and thank you, Aletta. I see you there nodding, and I gave you a break to have some water, and you had an extended break, so I'll make up for it next month. But everybody enjoyed. I hope you enjoyed today, and good luck with your 30 June 2022 reporting. I hope it goes well.